Hello friends. Now we'll be taking up in this part of the session the chapter of dividend decisions. Now this, as I told you in the earlier lectures, that three chapters have been introduced in the intermediate syllabus, of which one is this dividend decision. You can name it as dividend decisions. If you want, you can even call it dividend policy. Now let us understand first again the same thing, friends. We will be discussing the meaning and the objective. Then I'll explain you what is the scope of this chapter, what are we going to learn in this chapter, and then suddenly we'll take a break, we'll move on to some different segment, and then we'll again come back to this chapter. So first of all, tell me, what do you understand by the word dividend? Dividend means what? How would you interpret the word dividend, friends? Dividend, an act of distributing profits, is called dividend. So what is the meaning of the term dividend? An act of distributing profits is termed as dividend. Now, so what is the objective of this chapter? Why is this chapter kept in the syllabus? This chapter will also help us to take decisions only. But decision in respect of what? Let us understand, friends, this way. Let us create a situation. Let's presume that you are a finance manager of a company. Your company in current year has made profits. Now it is the company which has the power, has the choice to decide out of that profits what percentage of profits should be distributed amongst the equity shareholders. So what should be the appropriate payout ratio that we should give to our equity shareholder? What percentage of profit should be distributed amongst the equity shareholders? Don't you think, friends, if you become a finance manager, you will be facing this situation? You have to decide that whether our company should distribute profits as dividends or not. If yes, then how much? This question you will face in practical life, and that itself is the objective of this chapter. So what will this chapter teach us? See, we have discussed the meaning of the term dividend, an act of distributing profits. Now, objective, what will this chapter teach us? It will help us to get the answer to this question that we are going to raise, whether a company should distribute profits as dividends or not. This is one question. And if suppose you get the answer yes, if yes, then how much? This is what we need to answer. So when I say whether a company should distribute profits as dividends or not, if yes, then how much? Acha, we can even call this as whether a company should distribute profits as dividends. That is, we can say what should be the payout ratio. That is, what percentage of profits should be given as dividend. This is what we need to decide here. Now, don't you think this situation you will be facing in practical life? Yes, of course, you will be facing. So how would you decide whether our company should give dividends or not? What should be the payout ratio? What percentage of profit should be given as dividend? How will you decide that? Your answer to this question is also simple. The answer is as follows. Company should distribute dividends. Company should distribute dividends. That is, I would say, that is, adopt a payout ratio adopt such a payout ratio which will maximize the wealth of equity shareholders. Understand, company should distribute dividends, that is adopt such a dividend payout ratio which will help the company to maximize the wealth of equity shareholders. Now, wealth, when it will increase, wealth increases whenever MPS increases. So my objective is very simple. I should adopt such a dividend payout ratio. I should distribute that much part of profits as dividend, which helps me to maximize the wealth. And wealth is synonym to the word MPS. Wealth increases whenever market price of the share increases. In short, summary goes this way. I should adopt such a payout ratio that will help me to maximize the market price of the share. My question now is way too simple. If it will maximize the market price of the share, does this dividend policy, when I'm using the word dividend policy, just at the back of your mind you can say it's nothing but a payout ratio. Will dividend policy of the company have any impact on MPS? What is your view? आपको क्या लगता है, will distributing profits in a particular manner, in a particular pattern, does it really affect the market price of the share? If yes, then I should give that much part of profit as dividend, which can help me to maximize the MPS. So keep this thing at the back of the mind. My answer is very simple. Give a payout ratio, distribute profits as dividend, which will help me to maximize the MPS. So is there any relationship between the two? Does a payout ratio affect MPS or not? What is your opinion? Does this payout ratio of the company affect MPS or not? Now many people would come out to the conclusion, yes sir, dividend policy definitely has an effect on the market price. The way you guys are having an opinion, there are few set of authors, there are few theories which also have the same opinion which you guys have. So that itself is the scope. What we need to understand here is, are those theories. So there are few theories which also have the same opinion which you guys have, that yes sir, there is a relationship between payout ratio and MPS. A particular payout ratio will naturally help the organization to maximize the APS. So there are couple of theories which we need to learn that also have the same viewpoint. That is, as per these theories, dividend is relevant. So we have dividend relevance theories. And what is the viewpoint of these theories? Dividend, ki bhai, particular payout ratio definitely affects the market price of the share. So there exists something called as optimum payout ratio, and optimum payout ratio is that where MPS will be maximum. Whereas we have one theory which considers dividend completely. When I'm saying dividend relevance theory, dividend payout ratio is relevant in determining the market price of the share. Then we have dividend irrelevance theory. And as per this theory, you distribute how much soever profits you want as dividend. It will never affect the wealth of the shareholders. Wealth of the shareholder is completely independent to the payout ratio. Wealth has no relevance, and there's nothing called as optimum dividend payout ratio. Give any payout ratio that you want. Give any payout ratio, your wealth of the shareholders remains the same. And then we have to understand one concept of about practical approaches. So we have some practical approaches. We have dividend relevance theory, irrelevance, and we have practical approaches. This is what we have into our syllabus. In these dividend relevance theory, there are three theories which we need to learn. One is the Walters model. Then we have the Gordon's model, which we have done with a discussion somewhere. And then we have the Graham and Dodd model. Now Graham here is Benjamin Graham and David Dodd. Benjamin Graham. Benjamin Graham is called as father of value investing. You people would be aware about a person named as Warren Buffett. He is one of the richest known investors across the globe. Even Warren Buffett considers Benjamin Graham to be his guru. So Benjamin Graham is known as father of value investing, just for your knowledge purpose. Now we have dividend irrelevance theory. Now in dividend irrelevance theory, we have to learn approach. What is the viewpoint of all these theories? The viewpoint of all these theory is that dividend policy of the company, when I'm using the word policy, it is nothing but payout ratio. Dividend payout ratio of the company does affect the market price of the share and consequently the wealth. That means as per these policies, you will have something called as optimum payout ratio, which can help us to optimize the wealth of the shareholders. Whereas मॉडल क्या बोलता है, तुम डिविडेंड दो मत दो कुछ फर्क नहीं पड़ता, wealth of the shareholder remains the same. So this is your irrelevance theory. In practical approaches, we have to learn two approaches. One is the residual approach, and then we have Lintner's model. This is what is the scope of this chapter, friends. This is what we need to learn in this entire chapter of dividend policy. So basically you need to remember, see, if you remember friends, in capital structure theories, changing the capital structure changes the WACC. Then there was one theory says, two theories, तुम पैसे कैसे भी arrange करो, KO is unaffected because of capital. Same logic is being applied here. Changing the payout ratio would affect the market price, and these are the theories which are giving that confirmation that yes, if you change the pattern of giving the dividend, the proportion in which you are going to give dividend, it will affect the market price of the share. So there will be something called as optimum payout ratio. Here these theories are, अरे जाने देना, जैसा देना है वैसा दे, कुछ फर्क नहीं पड़ता. And then the practical approaches, which is usually followed in practical life, ऐसे बोल सकते हो आप, ठीक है. Now this is a scope, but before I begin with all these theories, it will be mandatory for us first, friends, to understand valuation techniques, because till the time you do not understand the techniques of valuation, it will be very difficult for us to absorb these formulas. See, I could have given you the formulas as it is, presuming that you people are done with the revision, because you are already, it is being assumed that you people are already done the revision. Here it, on your own, we are just going to give you a brief recap. So I could have given you the formulas as it is, but then it will be difficult for you to understand those formulas. So what I would prefer here is, first I would like to take up the concepts of valuation, valuing the equity shares, and once that concept of valuation of equity is done, then believe me friends, knowingly unknowingly, you on your own voluntarily will be developing these formulas. So first, before I proceed further, I would say that this being a theory, you can just take a screenshot of these things, so when you do the revision during your exam time, fastly you can brush it up. Okay, so I hope everyone has noted the stuff that we have discussed just here. Now, before I start with all these theories, as I told you, it is mandatory for us to understand the concept of valuation. So let's discuss the valuation concept, and then we can understand these theories easily. So let us understand valuing the equity shares. Valuation of equity shares. Friends, this chapter of valuation of equity shares is, I would say, the concept of valuation rather is an ocean I would say. Lot of stuff we are going to discuss at final CA level on valuing the equity shares. At present, I'll be discussing only the stuff that is required, which can help me to make you guys understand those formulas. Okay. Now, What exactly do you understand by the word valuation, friends? Define the term valuation. Valuation, it is nothing but a process which is followed to determine worth of any asset is valuation. A process which we follow to determine worth of any asset today, it is called valuation. I can give you an example which I usually give in the classroom, and you won't believe the answer that they will come up with will be what I'll tell you. First, the question that I would like to raise here is, suppose after the lectures are getting over, this is the same example that I take in classroom, so please listen to it. Once the lectures get over, let's presume we are on our way back home. Now, on the way back home, we come across a store which sells shirts. Now, on a mannequin, there is one shirt which you liked a lot. Now, what will happen? You will think this way, looking at the color, looking at the brand, looking at the fabric. Can I say immediately you will frame a price in your mind? This happens on a regular basis, and when I ask the question, people in the classroom will shout white shirt and all. So but you should understand what I'm telling you is ki when on the mannequin you will look at the shirt, immediately you will definitely frame a price into your mind. So let's presume this way, looking at the shirt you said यार मस्त शर्ट है यार, मेरे हिसाब से तो 500 रुपए का तो वो शर्ट होगा ही. अच्छा, what is this price? Is this actual price? No, this is your expected price. This is what you expect the price of the share to be or the shirt to be. कि मेरे हिसाब से तो 500 रुपए का शर्ट होगा ये. Now, you went to the store and you asked the store manager, अरे वो शर्ट कितने का, वो मैनिक्विन पे जो पड़ा है वो कितने का? He says 250 rupees. तो you'll say, now there are two prices. One is 500, the other is 250. Between the two, which is the actual price? Can I say 250? Now what is this 500? It is the expected price. मेरे हिसाब से इस शर्ट का वैल्यू इतना होना चाहिए. अच्छा, वो 500 रुपीज आपने जो दिमाग में कैलकुलेशन किया होगा, कहने से कुछ तो प्रोसेस फॉलो किया होगा to determine that worth of 500 as the value of the shirt. Knowingly, unknowingly, intentionally, unintentionally, you must have followed some process. That process which you have followed to determine that worth of the shirt is called valuation. Now, if in my example of shirt, if I change the commodity shirt and I make it share, if I want to value a share, if I want to determine what is the worth of that share, I need to follow a process. The process that I'll follow to determine worth of the share is called valuation. And believe me friends, there are numerous models available to determine worth of the share today. Numerous model. One amongst them is discounting cash flow techniques. So let us understand the valuation of the share on the basis of discounting cash flows. Let me explain you. So how do I value an equity share? Value or worth of an equity share today, worth of an equity share today is going to be just equal to, worth or value of an equity share today is just equal to sum of the present values of all future benefits. Now when I'm using the word benefits, it means what? Cash inflows. Value of the share today is just equal to sum of the present values of all future benefits discounted at our desired rate of return. Did you get this? What did I say? Value of an equity share today is just equal to sum of, that is addition of, all the present values of all future benefits discounted at the desired rate of return. So let me explain you here what exactly is the scenario. So if I go by the logic, value of the equity share today, value of equity share today, worth of equity share today, which is going to be denoted by letter P0, price of the share today. And remember, this is not the actual price. This is which price? This is the expected price. The worth of the equity share today is going to be just equal to what? Sum of what? Sum of the present values of all future benefits. Sum of the present value of all future benefits. Benefit means cash inflow. Acha, so if you buy the share today, what benefit you will get? Can I say benefit that you will be getting will be in the form of cash inflows by way of dividends. So what I'll have to do is I need to check how much dividend I'm going to get in year 1, how much dividend I'll get in year 2, how much dividend I'll get in year 3, how much I'll get in year 4, and so on. But all these dividends, friends, which I'm going to receive, I'm not going to receive it today. It will be received in future. But I am interested in finding out the value today. So what will I do? Simple. I'll discount all these dividends. And to discount, I will need a discounting factor rate. What is going to be that? That's going to be my desired rate of return. So I'll discount it with the discounting factor of year 1 now. You are going to be an equity shareholder here. Your desired rate of return is denoted by letter, whatever is written expected to use cost to me, it is denoted by letter KE. So I'll discount these cash flows by using the discounting factor of year 1. This will be discounted by using discounting factor of year 2, discounting factor of year 3, and so on. So very simple it is. See, worth of an equity share today is just equal to sum of, when I'm using the word sum, it is addition. Sum of what? These present values. These are now present values. Present values of what? Of all future benefits discounted at your desired rate of return, that is KE. This is how we need to do valuation. Now what type of, first of all, next question, ये जो dividends मुझे मिलने वाला है, क्या वो actuals है या estimated? So these are all estimated. Now if your expectation is for future and you're discounting with your desired rate of return, तो जो answer मिलेगा क्या ना से वो भी expected ही होगा. What we are doing is, it is equal to sum of the present value of all future benefits. These are all futuristic value. These are all your expected value. So if you're discounting these expected value, if this is expected, can I say your answer will also be expected? Samjha? So value of the equity share is just going to be equal to sum of the present value of all future dividends discounted at your desired rate of return denoted by letter KE. Since these are all estimates, what different possible estimates you can make, friends? Tell me. As I am telling you here, since these are all estimated values, what different estimates you can make? One estimate that I can make is what, I may expect to get same level of dividends every year. My dear friends, when I say I am expecting same level of dividends every year, can I say I am expecting constant dividend every year? Are you getting it? If I go by the equation, let me do it this way. Let me make it in a different manner so that you can understand it. One way of estimations that I can make is, I may assume that every year, that is year wise, I may expect to get constant dividends every year. Matlab, let's presume this way. I am planning to buy the share of this company TCS. Last dividend paid by TCS, let's presume, was rupees 10. So one model that we have for estimation is constant dividend model. Constant dividend model. So what I can do, I can estimate that I'll get same 10 rupees of dividend every year. For how many years? For infinite life. Because we are assuming that a company will be having an infinite life, and it is a rational assumption, friends. I am not interested in how much dividend I'll be getting. I'm interested in knowing what is the worth of all those dividends today. So what will be the value of the share today as per this model? Price of the share today is just equal to sum of, now when I'm using the word sum, it is addition. sum of what? The present values. So all these being futuristic, I'll discount it and I'll bring it to present value, but discounting it with discounting factor of year 1, discounting factor of year 2, discounting factor of year 3, discounting factor of year 4, and so on. One way to find the price of the share is to keep on discounting. But sir, how can we discount the cash flows for infinite life, sir? That's not going to be possible. So if you expect that you will be getting 10 rupees of cash flow every year, then mathematically, friends, mathematically, the above equation, it can be proved as what? That P0 is just going to be equal to D by KE. That means I would say this way, if it is constant dividend model, if I go by the original equation, it's D1, D2, D3, D4. Now when I'm expecting that I'll get same dividends every year, whether I write D1, D2, D3, D4, or if I just write D, will it do? Yes. If you carefully analyze this series, friends, believe me, it takes form of an infinite series of a geometric progression. Using infinite series of geometric progression, sum to infinity ka formula, we can actually prove that P0 is just equal to D by KE. We don't have to prove it, but we can prove it by using the sum to infinite series of geometric progression. So answer by this logic and answer by this formula will be same, because this formula is actually a derivation of the series. So I would say there are two ways to get the same answer. One by using the logic, and the same answer you can get it by way of the formula, because this is actually a derivation of this. When will this formula work, friends? First of all, tell me, when do you think this formula will work? So here my expectation is what? I'll get 10 rupees of dividend every year. Answer by this logic and answer by this formula will be the same, provided some assumptions are true. When will I get the answer by this formula and this series the same? 1. I am assuming that I'll be getting constant dividends every year. So my dividend has to be constant. Every year I expect constant dividends every year. So dividend is constant. The denominator, that is KE, that is also constant. And the third assumption is the company should have infinite life. If these three assumptions are true, then answer by this logic and answer by this formula will be the same. So in order for us to make use of this formula, we have to remember those three assumptions. 1, the company is expected to have infinite life. 2, dividend that we expect is constant. 3, KE is constant. If all the three assumptions are true, then we can very well make use of the formula. Now, before I take up the next model, here I am assuming that we'll be getting constant dividends every year. I can change my expectation. Estimate ही करना है ना, तो आप कुछ भी कर सकते हो. Okay. But before we move on to the next one, just for my satisfaction, tell me, what does the word P0 stands for here? Price of the share today. Which price? Actual price or expected? This is going to be my expected price. That is, मेरे हिसाब से शर्ट का जो वैल्यू 500 आया, अब मैं शर्ट की जगह पे शेयर कर दूं, तो मेरे हिसाब से शेयर का वैल्यू इतना होना चाहिए. दिस इज व्हाट इज माय एक्सपेक्टेड प्राइस, व्हिच कैन आल्सो बी टर्म्ड एज इक्विलिब्रियम प्राइस. यू कैन कॉल इट थियोरेटिकल वैल्यू, you can call it intrinsic value, fair value, justifiable value. You can have different names, indicated price, maximum price payable and all. तो ये मेरे हिसाब से एक्सपेक्टेड प्राइस हुआ. अब इसका फायदा क्या होगा? Suppose when I use this formula, मुझे आंसर आया expected price 120 rupees. मेरे हिसाब से price of the share होना चाहिए 120. Then I'll go to the share market and I'll check and ask for someone. Are I am interested in buying the share of this company. Is anyone willing to sell? Somebody says yes, I am ready to sell. I then ask him at what price. He says 115. आप क्या सोचोगे? मेरे हिसाब से ये शेयर का वैल्यू 120 होना चाहिए. ये बंदा 115 में बेचने के लिए तैयार है, तो कैन आई से यू कंसिडर द शेयर currently undervalued, and since you consider it to be undervalued, it is advisable to buy the share. समझ रहा है? So it helps us again in taking decisions whether a share is currently overvalued and undervalued, and then we can take appropriate actions. Is it okay? Just take it at the back of your mind that valuation is nothing but discounting all the future benefits and bringing it into present value. Just add up, take sum total of all these things, and then whatever you get is going to be the value of the share. Since discounting for infinite life is not possible, and if I'm expecting constant dividends every year, if I discount these cash flows and if I bring it to present value and then if I add it, I can get the same answer by using this formula. Formula works provided assumptions are true. The assumptions are D should be constant, that is expected dividend should be constant, K should be constant, and the company is expected to have infinite life. If these assumptions are true, then only formula should be used, else formula will fail to work. If you can develop some relationship with this formula with something which we have already learned in the cost of capital chapter, you would realize in cost of capital chapter we were actually using the same formula but in a different manner. देखो, यही फॉर्मूला को अगर मैं उल्टा पुल्टा करूं और बोलूं के ई ढूंढो तो कैन आई वुड से सर के ई इक्वल्स डी बाय पी जीरो. अरे दैट इज एक्चुअली नथिंग बट डिविडेंड प्राइस अप्रोच, दैट इज डिविडेंड यील्ड मॉडल. Actually speaking, friends, for your knowledge, this is the original formula. Original formula developed is this. We do ulta pulta to this formula and we make it use in the chapter of cost of capital to determine the KE. समझा? पक्का? Okay. So this was valuing the equity share, and in valuing the equity share, we are using constant dividend model. Can I say this constant dividend model? Are you expecting your dividends to grow every year? No. This can hence be termed as zero growth model. This is zero growth model. This is one way to estimate the price of the share. Now, as we all know, if I go by the original equation, price of the share today, that is denoted by letter P0, price of the share today is just equal to sum of the present values of all future benefits discounted at my desired rate of return. Then can I say, friends, यहाँ पे ये सब values estimated है. अगर ये estimated है, एक possible estimate है, I may expect to get same dividends every year. I would expect history to repeat. But me being equity shareholder, I can always expect some growth in dividends. So if I expect growth in dividend, then what will be the change in the formula? That will be the next part of the discussion. So we will now take up the next model, that's going to be constant growth model, and that is also more popularly called as Gordon's formula. So how Gordon's formula is going to be used for determining the value of the share, that is what is going to be the next part of the discussion. So we'll understand that in a while. So let us now take up the next model, which is going to be the constant growth model. Now this constant growth model is also known as Gordon's formula. Now let us understand this model, and to begin with, let me take an example again here. Suppose, friends, we are interested in buying the share of this company TCS. Will you simply buy it? जैसे आपको लगा अरे यार TCS buy करें, सीधा जाके buy करोगे क्या? नहीं. Before buying this share, definitely you would like to do some calculation. What calculation you would like to do? You will first check what is the real worth of the share of TCS. Now to determine that, you will require some additional data. So let's presume this way. Your research indicated that the last dividend paid by TCS was say rupees 10. You desire a rate of return of say 20%, so that's 0.2. And you are expecting that your dividend should grow at 10%. Now if you are interested in buying the share of the TCS, What is the worth of the TCS? I need to find that. How will I determine that? As I just discussed, friends, value of the share today denoted by letter P0, price of the share today, is going to be just equal to sum of, now when I'm using the word sum, it is going to be addition. Sum of what? The present values of all future dividends. मतलब मैं ये सोचूंगा कि मुझे ईयर 1 में कितना मिलेगा, ईयर 2 में डिविडेंड कितना मिलेगा, ईयर 3 में कितना, ईयर 4 में कितना, and so on. Now these are all dividends that I am going to get in future. I want to find the value of the share today. So what I'll do, I'll discount it. I'll discount means I'll divide it and I will reduce it and bring it to present value. So I'll discount it by using my discounting factor of year 1, discounting factor of year 2, discounting factor of year 3, discounting factor of year 4, and so on. So I would say this way, value of the share today is just equal to sum of addition of the present values of all future dividends discounted at our desired rate of return. Now, if I am following constant growth model, and if TCS in the past has given me a dividend of rupees 10, how much dividend do you think I will expect here? So I'll expect dividend of rupees 11, 12.1, 13.31, 14.64, and so on. So this is what is going to be my pattern of dividend. One way to determine price of the share today is discount this, discount this, discount this, discount this, and so on. Discount these dividends for infinite life. Sum it up, that will give you the formula or the amount of price of the share today. Now, one way to get this answer is by individually discounting those cash flows. But discounting till infinite life, we all know that it is not possible. So what am I supposed to do? I have to have a different approach. Now, if you again actually, look at the series, you would realize that this also takes form of an infinite series of a geometric progression. And using sum to infinity of geometric progression, that is mathematically, again it can be proved what? That P0 is just going to be equal to D1 by KE minus G. I am again repeating the same answer by this logic, that is individual discounting, and answer by this formula will be the same. Mathematically, this entire series can be summarized by way of this formula as P0 equals D1 by KE minus G. Now, if you actually look at this formula, it is the same formula which we were using in cost of capital for computing KE as per Gordon's formula, KE equals D1 by P0 plus G. It was the same thing, but expressed in a different manner. See, so I would say if I transposition this formula, it is KE minus G equals D1 by P0, and then you add G here, that's going to be D1 by P0 plus the G. Same formula we were using in cost of capital. There we were using it with an objective to get KE. Now here my objective is not to get KE, but my objective is to get P0. So P0, what is this? I want to give notings to this. What is P0? This is actual price or expected price? Expected price. What is this D1? Mandatorily, for calculating P0, if you're following Gordon's formula, mandatorily it has to be P0 equals D1. And how did I get the D1? D1 is nothing but D0 plus I have added the growth rate, that is giving me D1. So it's going to be D1 by KE minus G, where D1 is expected dividend of the first year, that is last dividend plus the growth rate. KE is your desired rate of return, your required rate of return. You can even call it as capitalization rate, or you can even say opportunity cost available to the equity shareholders. G is the growth rate in dividend, which is assumed to be constant. So I'm again repeating, friends, if I want to determine price of the share today, one way is discount. Keep on discounting, but we know that discounting till infinite life is not possible. So the same answer I can get it by way of this formula. That is going to be P0 equals D1 by K minus G. Now my question, while developing this formula, again Gordon had taken many assumptions. So one by one, you please tell me what assumptions we have taken. The first assumption is the company is expected to have an infinite life. Company is expected to have an infinite life. Second, G, that is growth rate in dividend, is assumed to be constant. A G constant. Every year the dividend of the company will grow at a constant rate. That is the second assumption. Third, KE is constant. So G is constant, KE is constant. The fourth assumption, friends, KE should always be greater than G. If KE is less than G, KE should always be greater than G. If KE is less than G, your answer here will come negative, and price of a share could be either 0 or it will have no price. It can't have negative price. So if these four assumptions are held true, then answer by this formula and answer by this logic will be the same. Is it okay? Which are the four assumptions? Please repeat. Company is having infinite life, K is constant, G is constant, and K should always be greater than G. Then and only then you should follow this formula, else you should not. Sir, what if we can't follow the formula? Then if you can't follow the formula, you have no choice but to use the logic. So if you can't make use of the formula because of failing of any one of the assumption, formula will fail to work. So you have to then use logic, that is discount these cash flows individually. Is it okay, friends? Pakka? Okay. Now one question I would like to ask. In this first model and the second model, in the first model, the formula was P0 equals D by KE. That means we were assuming that we will be getting dividends each year. We were expecting that we will be getting dividends every year. But there are so many companies, friends, you will find in practical life, who do not pay dividend. So if they do not pay dividend, does it mean their price of the share will be 0? Does it mean that their price of the share will be 0? No. In their case, the valuation can be done by using different models. So in that case, we won't discount dividends. What we'll do, in that case, we can substitute earnings. So if I write P0 as E by KE, then it is earnings discount model. Here what we are doing, we expect that we will be getting dividends, and hence we are considering dividend to be a relevant factor in determining the price of the share. But there are companies who don't pay dividends. So if you don't get dividends, then does it mean dividend here will be 0, so price will be 0? No, you need to adopt a different approach. So one more approach possible is you may discount what? The earnings. So if you discount the earnings, then it becomes earnings discount model. That's going to be E by KE. And the moment you write E by KE, what implied assumption you have taken? Company is having infinite life. Anything when you are capitalizing it with K, D by KE can anything. It is simply to be presumed that the company is having infinite life. Numerator is constant, denominator is constant. If I expect my earnings to grow every year, so instead of using P0 as D1 by K minus G, I'll take E1 by K minus G, where E1 is going to be expected earnings per share. Samjha? So it's just variation. Then at final say we will even learn that there's something called as free cash flows model. So there we don't give preference to dividend, we don't give preference to earnings as well, we give preference to free cash flows. So multiple possibilities are there, friends, because valuation is subjective. You need to just be able to justify what process you have followed to do the valuation. That's the only thing. Fine. So after doing this basic discussion about valuation, then we can begin with the chapter of dividend policy. There are various approaches which we need to understand under the dividend policy chapter. That's it. That's a very simple chapter. My personal opinion would be, whenever you get a sum in the exam on leverages, on dividend policy, finish those sums first, because believe me, it won't take much time for us to finish off these two chapters sums. They are very easy for us to solve. So begin with these two sums in the exam if they are asked in the exam. So now I'll begin with the Walters model, that is the dividend policy theories. Okay, so now after discussing the basics of valuation, let us take up the first model, that's going to be the Walters model. This Walters model was developed by Professor James Walter. अब सबसे पहले what is the viewpoint of Walter? What is the opinion of Walter? Will dividend policy, when I'm using the word dividend policy, will dividend payout ratio have any effect on the market price of the share? What is his opinion? Same. Yes, it does affect the market price of the share. Now, if it does affect the market price of the share, that means as per Walter, there will exist something called as optimum payout ratio. And at that optimum payout ratio, the wealth of the shareholders will be maximum because MPS will be maximum. Now, how did Walter prove his point? Let us understand all these things with the help of an example. First, let me develop the formula of Walter. What did Walter suggest? See, the way Gordon has developed the formula for computing price of the share. What is the formula for price of the share as per Gordon's formula? D1 by K minus G. Even Walter has developed a formula for getting P0. So we have P0. Now, for better understanding, let's take it this way. Friends, tell me, if I write the formula like this, D by KE, what exactly is this? Tell me, it is which model? D by KE. This is which model? This is actually nothing but constant dividend model. What are the assumptions that I've already inbuilt taken in it? Company is having infinite life, dividend is constant, and KE is constant. Now friends, if instead of D, if I substitute E, then this becomes which model? Constant earnings model. Implied assumptions क्या हो गए? Company is having infinite life, E is constant, KE is constant. Now, first of all, how he has developed the formula, let's understand. So the basic start itself is E by KE, where E is the expected earnings of each year. KE is the desired rate of return by the equity shareholders. It is the required rate of return by the equity shareholders. You can call it as capitalization rate. You can even call it as opportunity cost available to the equity shareholders. Now, if I now do some, transpositioning here in the formulas, I can write it like this. Friends, tell me, if I write the formula like this, E minus D plus D, will it do? What am I doing here? Minus D plus D तो any which ways cancel होने वाला ही है. तो what am I doing again? I'm just capitalizing the earnings. अच्छा, can I write this part of the formula in this manner as D plus E minus D? चलेगा? Yes, D minus D cancels. Again, it is the same thing, capitalizing the earnings. Now, what did Walter do? Acha, before I proceed further, what is this D now? Expected dividend per share. What is this E? Expected earnings per share minus D. Acha, E minus D क्या होता है? E minus D. This is the earnings minus the dividend. वो क्या होगा? Can I say retention? Now this retention was being multiplied with R, something called as R, and then this was divided with KE. So the formula is, as per Walter's approach, I would say, as per Walter, P0 is just equal to D plus E minus D into R by K. The whole we need to divide it with K. Now, why did he do this R by K? Give me some time, I'll explain you that also. So, but first of all, just understand this formula of Walter. P0 equals D plus E minus D into R by K. The whole we need to capitalize with K. And understand, friends, when the numerator is just divided by this KE, impliedly assumptions taken is what? Company is having infinite life, D is constant, E is constant, R is constant, K is constant. ये inbuilt assumption हो जाता है. आप numerator में कुछ भी लिखो, denominator में अगर आप KE लिख देते हो, तो impliedly numerator constant हो जाता है. ठीक है? That means company is having infinite life and the numerators, all things are constant. Now, what does Walter suggest? What is the viewpoint of Walter? Walter says that dividend policy of the company does affect the market price of the share. That is, when a company gives a particular payout ratio, that particular payout ratio does affect the market price of the share and consequently the wealth. Now, how did he prove his point? Let's understand the same with the help of an example. Let us presume, friends, that the company has an EPS of rupees 10. R is say 15%. Honestly tell me, what does this R stands for? Ratio chapter, ratio. R. R is nothing but the returns which the equity shareholders, the company earns for its equity shareholders. R is 15% and KE is 10%. Now for better understanding, let's take it this way with the help of an example by way of balance sheet. If I now prepare the balance sheet here, if you remember, let's presume you guys are the equity shareholders. For understanding purpose, let's take it this way. You guys are equity shareholders and you people have given me equity. X amount का आपने equity दिया है. Now, what will I do with this money? I will invest it in the asset. Now, when you're giving me this money, are you giving it with an objective to do charity? No, not at all. You would expect some returns. Now, on this investment that you're giving me, you guys are expecting 10%. Acha, how do we interpret this 10%? Tell me. How would I interpret this 10%, that is KE of 10%? It is your desired rate of return, and whatever you desire becomes cut off for me. Now my question is, why are you desiring 10%? Why do you want me to earn 10%? Because you know that if the same money which you have given me here, had it been invested by you somewhere else, at least you could have earned 10%. That means, can I say this KE is nothing but opportunity available to you elsewhere as well? So KE has different meanings here. This is what you're expecting from me. So this is your desired rate of return. It is your required rate of return. Whatever is your required rate of return, it is KE, cost to me, cut off to me. Now, why are you expecting 10%? Because you know that यही पैसा अगर मैं कहीं और invest करता तो मैं 10% कमा सकता हूँ. तो उतना तो मुझे company भी देना चाहिए. So this is going to be KE. What is R now? Understand. अब यही पैसा मैं यहाँ पे invest karunga on your behalf. I'm talking from company's point of view now. Now, when I'll use this money, can I say I'll be able to generate some rate of return for you? What I should earn is 10%, but I am earning is 15%. So that's going to be the R. That is the rate of return which the company earns on the equity shareholders funds. That is denoted by letter R. Now, what did Walter suggest? Now, before I actually proceed further, these are the three scenarios. And we have the EPS, we have R 15% and KE of 10%. The company has the following option of paying the dividend. So we have dividend payout. Company has three choices. It can pay either a dividend of say rupees 0. It can give a dividend of say rupees 10. It can give a dividend of say rupees 3. That means, what is the earnings? Tell me, what is the earnings? The earnings here is 10 rupees. One option I have is, out of this earnings, 0 rupees I will give as dividend. Other option is full 10 rupees I will give it to you as dividend. That means 0% of the profit I will retain, 100% payout ratio. Here 0 payout ratio, here 30% payout ratio. Now, if this is the information, I am earning 10 rupees, R is 15%, that is I can earn 15% for you. You guys are expecting 10% and I have three choices. You guys think on your own and tell me, if you are a finance manager of this company, what action would you take which would help the company to maximize the wealth of the equity shareholders? क्या लगता है? आपको क्या लगता है? इस केस में should I give 0% of the profit as dividend? Should I give 100% payout ratio or should I follow 30% payout ratio? According to you, what should be the payout ratio that I should adopt here? Tell me, think. I would definitely get the answers in the classroom when I would have asked. Maximum people would be giving me the correct answer. You know what they will say? Sir, if this profit is distributed as dividend to the equity shareholder, they would have invested it elsewhere. The best returns they could have earned elsewhere would have been at the rate 10%. But if the company is retaining these profits, and if it is keeping with itself, and if it is reinvesting it, company is able to earn what rate of return? Company is able to earn 15% rate of return, which is much more than what the equity shareholders can earn. And hence in this situation, since the company is able to earn higher returns as compared to what the equity shareholders are able to earn, it is in the interest of the equity shareholders, company should not distribute profits as dividends. In this case, company is advised to retain entire profit. I can say this way, see, ये जो E minus D into R by K किया ना, वो actually है क्या? अगर ये प्रॉफिट E minus D जो मैं रिटेन कर रहा हूं, if I don't retain it, what I would have done? I would have distributed it. If I would have distributed it, what you guys would have done? You would have invested it elsewhere. And can I say you would have been able to earn KE? If this profit, I was not keeping it with me, but had I distributed it, you could have invested it, you could have earned return. And the return which you could have earned elsewhere would have been at the rate K. That's the reason that much you're expecting. But how much extra return am I able to earn on top of your returns? That is this. It is actually nothing but cross multiplication. So this E minus D into R by K is actually cross multiplication. This shows how much extra returns the company can earn over and above the opportunity that is available with the equity shareholders. If you notice now here, the company can earn 15%, which is more than what the equity shareholders can earn elsewhere. So it is in the interest of the equity shareholders that company should not distribute any profit as dividend, because by doing so, company would be able to maximize the price of the share, consequently the wealth. Did you get this? So whether I should follow, this is actually cross multiplication. If this profit was not retained, it would have distributed, you guys would have invested it at KE, you would have earned this much. But if I don't distribute it, I will earn this much. So how much extra return am I earning over and above the opportunity available with the equity shareholders? Now, suppose friends, if I change this scenario and I make this as 5%, what I can earn is 5%. You guys can earn elsewhere 10%. So what should I do? When I know that you can earn elsewhere 10%, then it is in the interest of the equity shareholders. In this case, the company should distribute entire profit as dividend. Because in that case, if the company does distribute the entire profit as dividend, that situation will help the company to maximize the price of the share, consequently the wealth. Now let's understand how does it, we now have to quantify that. क्वांटिफाई करना है कि अंडर विच सिचुएशन प्राइस ऑफ द शेयर विल बी मैक्सिमम. तो आप नोटिस करो, आई कैन मेक द हेडिंग लाइक दिस, एज पर वॉल्टर्स फॉर्मूला. फर्स्ट आई विल राइट द फॉर्मूला. P0 is just equal to D plus E minus D into R by KE, the whole by KE. How many situations do I have for the dividend payout ratio? One situation is DPS is 0, that is my payout ratio is 0%. So is this policy optimum? Let me check by using Walter's model. Let me check. The other option is DPS can be rupees 10. Now that means my payout ratio here is how much? 100%. And the third situation is DPS is rupees 3, which means I am adopting a payout ratio of 30%. Which among the three do you think is the best policy? Now to determine which among the three is best, only thing I have to do is compare R with KE. Now in my example, R here is greater than KE. Since R is greater than KE, it means company is having better opportunity available for investment, and hence the company should not distribute any profit as dividend. Because if company does not distribute the profit as dividend, it will help the company to maximize the price of the share. Let's understand now. That means in my case, I will be getting the best answer, payout ratio 0. यहाँ पे market price सबसे best होगा. अब मुझे वो justify करना है by doing this working. Now what is the dividend per share? 0. EPS is 10 minus 0. What is R? 15%. 15% can I say is as good as 0.15. How much is KE? 0.1. So now I need to capitalize it. That's going to be 0.1 now. I'm applying the values now in the formula. So that will give me a price of the share of rupees 150. So if no dividend is distributed, price of the share will become 150. Now here I will give entire profit as dividend. That means 10 rupees here, earning is 10 minus 10 into 0.15 divided by 0.1, the whole by 0.1. I think when you solve this, this is going to give you 100 rupees. So if you notice, if I can earn higher returns than what you can earn, and in that case, if I am going to give you dividend, I am doing injustice for the organization. So because that will actually minimize the price of the share as per Walter's approach. Here I will give dividend of rupees 3, 10 minus 3 into 0.15 by 0.1, the whole by 0.1. I think when you do this calculation, you will get 135 rupees or something like that. So let's check whether we are getting the answer correct, 135 or 130, something like that. So that's going to be 7 into 0.15 divided by 0.1 plus 3 divided by 0.1. Yes, that's going to give you 135 rupees ka price of the share. So now if you notice, which option is maximizing the price of the share? This option. That means for different dividend policies, we have different market price of the share, which means different wealth. And amongst these three policies, can I say the best policy is this? Why? Because this is maximizing the price of the share. Hence, point proved. The dividend policy of the company does affect the market price of the share. That means as per Walter approach, there exists something called as best payout ratio, and in my example the best payout ratio is 0%. Why I should not distribute any profit as dividend, friends? Give me the logic behind that. The reason why the company here should not adopt any payout ratio is because company can earn better returns as compared to the returns available for the equity shareholders. Suppose if I change here, what am I assuming? When R is 15%. Now if I change the R and I when R is 5%. So believe me friends, when you keep R as 5%, definitely price of the share will be maximum under this case. Because what the company can earn is only 5%, which is way too less as compared to the opportunity available with the equity shareholders. In that case, giving out profit as dividend is advisable because that will help the company to maximize the price of the share, consequently the wealth. Did you get this? Pakka? So if I summarize this entire discussion of Walter, I can say it this way. Walter considers dividend to be relevant in determining the price of the share. As per Walter, there exists an optimum payout ratio which can maximize the price of the share. As per Walter, when R is greater than KE, it means company is having better opportunities with itself that can be that can help the company to optimize the returns for its equity shareholder, which in turn will help the company to maximize the price of the equity share for its equity shareholders. When however R is less than KE, it means equity shareholders have better opportunity for investment elsewhere. So in the interest of the equity shareholder, company should distribute entire profits as dividend, as that situation will help the company to maximize the price of the share. Can I conclude, friends? As per Walter's approach, there can be only two best dividend policies. As per Walter, there can be only two best dividend policies, either 0% or 100%. When will the company, or when should the company adopt 0% when R is greater than KE? When should it adopt 100% when R is less than KE? So Walter's approach is also called as all or nothing approach, which means either give entire profits as dividend or give no profits as dividend. In between, if you keep anything, that is not advisable, because that is not going to give you the optimum price of the share. This was all about Walter's approach. So in exam, if you get a short note, you can definitely develop a short note saying that Walter considers dividend to be relevant in determining the price of the share. When R is greater than KE, company has better opportunities for investment, and hence in the interest of the equity shareholders, company should not pay any part of the profit as dividend. When, however, R is less than KE, it means equity shareholders are having better opportunity with themselves for investment. So to exploit that opportunity, what should the company do? Company should give them the entire profit as dividend, because that will in turn help the company to maximize the price of the share. When R and KE are the same, then dividend policy will have no effect on the wealth. Whether you give it or not, that will make no difference, provided R is equal to KE. Then you can even use the formula, and then you can say this way: in proving this point, Walter has developed a formula, and in this formula there are several assumptions taken. The assumptions taken are companies having infinite life, D is constant, E is constant, R is constant, K is constant, and so on. So if these assumptions are true, then the formula will give you the correct answers. Is it okay? So this was all about Walter's approach. We have sums that are based on Walter's approach. Let's finish off with those sums. I would suggest, for your reference purpose, if you want, you can take down this example. It will be helpful. Okay, so now let's take up the next model, that's going to be Walter's model. Okay, that's going to be question number 1 for us. Question 1. Let's read and finish it off. The earnings per share of a company are rupees 8, and the rate of capitalization applicable to the company is 10%. Now what and how would you interpret this rate of capitalization? Capitalization rate बोला तो चलो चलो बोलो क्या है capitalization rate? KE. The company has before it an option of adopting a payout ratio of 25% or 50% or 75%. Using Walter's formula of dividend payout ratio, compute the market value of the company's share if the productivity of the retained earnings is 15%, 10% and 5%. What inference can be drawn from the above exercise? So the question says, use Walter's formula of dividend payout, compute the market value of the company's share if the productivity of the retained earnings 15, 10 and 5%. So let us understand and compute this, and then we have to draw inference as well. Now whenever you have to answer any question which requires formula, so it's always advisable first to write down the formula. So I'm writing out the formula as per Walter's approach. P0 is D plus E minus D into R by KE, the whole by KE. Now the question says productivity of the retained is 15%. That means the question says that in the first situation, you tell us what will be the scenario of price of the share when R is 15%, and how many different payout ratios are we supposed to consider. If you notice, there are 3 different payout ratios. Payout ratio of 25%, so we say payout ratio 25%. Next situation, payout ratio 50%, and in the last one, payout ratio is 75%. So these are the scenarios that we have. The moment we have these scenarios, then if I tell you to calculate the DPS 25%, what is the EPS given? If I'm not wrong, EPS given is rupees 8, 25% of that will be 2 rupees. Here DPS will turn rupees 4 and here DPS figure will be rupees 6. Now, question to you is, before we do solve the sum, logically you give me the answer, friends. KE कितना बोला है? Capitalization rate applicable is 10%. So KE is 10%. Now when KE is 10% and R is 15%, which situation among the three R is greater than KE? मैं ज़्यादा कमा पाता हूँ, तो अगर मैं ज़्यादा कमा लूँगा तो definitely मैं आपको पैसे क्यों दूँ? I'll not distribute only. So in which case I'll be getting the price of the share the maximum. I'll get the price of the share maximum when the payout ratio is minimum. So under this case, my logic says the answer will be maximum here in this case. So let's check now. So I'll use the formula. D here is 2 rupees. E has been given by the question, that is 8 minus 2, that is D. R here is 0.15. Capitalization rate is 0.1. The whole is to be divided by 0.1. So when I do solve it, then you will realize it's going to be 6 into 0.15 divided by 0.1 plus 2, the whole to be divided by 0.1, that's going to be 110. So here my price of the share turns 110. If I adopt this scenario, so this is 4 plus 8 minus 4 into 0.15 by 0.1, the whole by 0.1. So when I do this, it goes like this: 4 into 0.15 divided by 0.1 plus 4, the whole by 0.1, that's giving me 100 rupees. So my price of the share, see, gradually is decreasing when my payout ratio is increasing. The only reason for this decrease is I am able to earn better returns, so I should not give any profit as dividend. Whereas here it is 6 plus 8 minus 6 into 0.15 by 0.1, the whole by 0.1. So how much is this coming to? So it is 2 into 0.15 divided by 0.1 plus 6, the whole by 0.1, that's giving me 90 rupees. So if you notice, the price of the share is decreasing. So when R is greater than KE, friends, we would say price of the share is maximum here. So this would be the best payout ratio. Now if I ask you, apply common sense, the best test payout ratio will be which one here? The best test one. Can I say not giving dividend at all would be helping me to maximize the price of the share much more as compared to this situation as well. Are you getting it? This is one scenario. In the second scenario, they say R is equal to how much? R is 10%. So when R is 10%, then what's going to be the situation? Now when R and KE both are same, believe me, policy of dividend will not have any effect on the price of the share. Use any payout ratio, price of the share will be the same. So I will say this way: 2 plus 8 minus 2 into 0.1 by 0.1, the whole by 0.1. So that's going to give you how much? Please check. 80 rupees. Now use any payout ratio. This is 4 plus 8 minus 4 into 0.1 by 0.1, the whole by 0.1. You will realize that it is going to give you again rupees 80. And here, so 6 plus 8 minus 6, 0.1 by 0.1. So you are getting 80 rupees here as well. So irrespective, any payout ratio you adopt, the price of the share is the same. Why this is happening, friends? Can anyone tell me? Because R and KE itself is the same. The last situation that we now have is R is going to be 5%. So now in the third case, when R is 5%, chalo, logically speaking, what should the company do? The company should not keep any amount of profit with itself, give it back to the investor, because investors can earn better return elsewhere. So I would say this way: it will be 2 plus 8 minus 2 into 0.05 by 0.1, the whole by 0.1. That's going to be first situation. 4 plus 8 minus 4 into 0.05 by 0.1, the whole by 0.1. 6 plus 8 minus 6 into 0.05 by 0.1, the whole by 0.1. So let's solve it, and believe me, the price of the share that you are going to get will be maximum in this case. It will be the maximum, the best in this case vis-a-vis the other. So let's do it. Into 0.05 divided by 0.1 plus 2 by 0.1. So this is giving me 50 rupees here. So this is 4 into 0.05 divided by 0.1 plus 4 divided by 0.1. That's going to give me 60 rupees. So price here is going to be 60, and here I think it's going to be 70 if I'm not wrong. Yes, that's going to be 70. So 70 rupees. Now if you realize why the price of the share here is maximum, what's the reason for this? Can you tell me what's the reason for this price being maximum here? Obviously the payout ratio, as the payout ratio will increase, the investors can invest that money elsewhere. They can generate better returns elsewhere. So rather than keeping money with us, it is advisable to distribute the entire profit as dividend. Tell me, these are the three situations. But if I now ask you a choice, if R is less than KE of 10%, which one do you think would be the best test payout ratio? 100%. Give entire profit as dividend, because that will help the company to maximize the price of the share. So if I want you guys to draw an inference about this exercise that we have just done, that is write an inference, draw an inference, what we can say, when R is greater than KE, when R is greater than KE, the price of the share is maximum when the payout ratio is minimum. When R is equal to KE, dividend policy has no effect on the price of the share. When R is less than KE, the price of the share is maximum when the payout ratio is maximum, because that signifies that the equity shareholders are having better opportunity for investment elsewhere. So in the interest of the equity shareholders, company should pay out the entire profits as dividend. I hope you guys have followed. This was Walter's approach. The next in the league is Gordon's formula, which we knowingly, unknowingly have covered up in valuation, because that constant growth model is nothing but Gordon's formula. And in that formula, P0, which is equal to D by KE minus G, don't you think if you change D, if you change the dividend, that is if you change the payout ratio, the dividend, the price of the share will get changed. And if the price of the share will change, so will the wealth. So even Gordon's formula, see, Gordon's formula is a general formula. It can come in any chapter and it can be used under any chapter. So irrespective from whichever chapter comes, since we know that the formula stays the same, you can use that formula for any circumstance then. But if I specifically discuss it from dividend policy point of view, I would say the formula is P0 equals D1 by KE minus G. If my payout ratio will change, that is D will change, P0 has to change. So even Gordon considers dividend to be relevant in determining the price of the share. The whole basis for P0 under Gordon's formula is dividend itself. So dividend change karoge, the price of the share change hoga hi. So even Gordon considers dividend to be relevant in determining the price of the share. So the next was that Gordon's formula that I have already discussed knowingly, unknowingly. Then we have couple of sums based on Gordon's formula. So that is what we'll have to discuss. But before that, I hope you guys have followed. This was solution to question number 1 of dividend policy, which starts from here. So this is question 1. Okay. So this was Walter's approach, and then now we can start solving sums on Gordon's formula as well. Okay, so now we have the next model that I told you just now, that is Gordon's formula or Gordon's model. Now we have already discussed it. What's the formula for Gordon to calculate the price of the share? As per Gordon's formula, this is actually discounting the cash flows. It is nothing but D1 by KE minus G. And my dear friends, what are the assumptions? चलो याद करो, मैंने ये सब explanation में दिया था. Assumption क्या है? कि assumption is KE is constant, G is constant, K should be greater than G, and company is having an infinite life. इसमें D1 क्या है? D1, how would you interpret the word D1? D1 is nothing but expected dividend. D1 is expected dividend of year 1. And friends, how do you calculate this D1? There are two ways to calculate this D1. One is D1 equals D0 plus the growth rate, that is last dividend paid plus add the growth rate in it. Alternate way to get D1 is, what you can do is just think how much you expect to earn in future. That is, I can say E1, how much you expect to earn in future, E1 into the payout ratio, because E1, E into payout, can I say is D? So if you take E1 into payout ratio will also give you D1. Now which formula do we need to adopt? That will depend upon the information provided by the question. So that is D1. KE is cost of equity. You can call it the capitalization rate, the required rate of return, and the desired rate of return by the equity shareholders, opportunity available with equity shareholders. G is growth rate in dividend. G is growth rate in dividend. Now, how is G calculated? If you remember in the chapter of cost of capital, at the end I have taken some concepts just about calculating the growth rate. How is this growth rate calculated? First, we can check past dividend data. If past dividend data is given, then we can extrapolate that and we can get to know what is going to be the growth rate. Then I gave you dividend of 2 years. In between dividend was not given, so we can use compound interest formula to get the growth rate. One more way to calculate growth rate was G equals B into R. B times R was going to give me the growth rate, where B is the retention ratio, R is the return on equity. That was a formula, and then we realized that if you simplify that formula, ये सब मेरे वो वीडियो में available होगा. It was EPS minus DPS, EPS minus DPS by book value per share will also give you the same answer. So this is the original formula. If you keep on simplifying it, it will give you EPS minus DPS upon book value per share. Now, so this was Gordon's formula, and even Gordon considers dividend to be relevant in determining the price of the share. If I change the value of dividend, can I say it is natural that it will affect the price of the share? Hence, proved that dividend is relevant in determining the price of the share. Now, so keep the stuff that we have discussed in mind. This was all about Gordon's formula. There's nothing much to discuss under Gordon's formula. So let's take up the sum related to Gordon's. Question number 2 now. Question 2. Let's read it. A firm paid a dividend of ₹2 per share last year. Tell me, charters, firm paid a dividend of 2 per share. So this is D0 or D1. This is actual or this is estimated? Actual. So this becomes D0. The estimated growth rate of dividend from the company is estimated to be 5%. Determine the estimated market price of the equity share if the estimated growth rate of dividend rises to 8%, falls to 3%. Also find out the present market price of the share given that the required rate of return on the equity to the equity investor is 15.5%. So they're telling you find out the present market price of the share given that the KE is 15.5%. Now, but nowhere they have specified that you have to use whose model. So to determine P0, they're telling you get the P0 if KE is 15.5%. That's fine, and the growth rate here is 5%. That's also okay, but now they have nowhere specified that in finding out this P0, whose model are you supposed to use? Whenever there is going to be growth, that is G, Gordon formula will prevail. So if there is growth rate, Gordon's formula will be used. Now, as per Gordon's formula, P0 is going to be just equal to D1 by KE minus G. Again, I will tell you the time tested technique. Your first target has to be KE. Always first KE. Target first KE. Check. Is KE given? Yes, sir. It is given. 15.5%. Now, 15.5% is as good as 0.155. Is growth rate given? Yes, sir. That's also available. That is 0.05. If I can get D1, then my job is done. Is D1 given? No. D0 is given. So how much is going to be D0? It is 2. But will you expect 2 rupees only? No, you expect your dividends to grow at what rate? 5%. So this is 2 plus 5%. So I would say this is 2.1 by 0.105. That's giving me how much? 2.1 by 0.105. Let's calculate the price of the share, friends. So this is 2.1 divided by 0.105. So that's giving me 20 rupees. So next question. Is it actual price, friends? Tell me. Is it actual price? No, this is expected price. So as per Gordon's formula, this is what I expect the price of the share to be. But now they say determine the price of the equity share if the growth rate rises to 8%. Now in the second case, this is the first case, existing P0. Second, if growth rate rises to 8%, then determine P0. So I would say P0 is equal to D1 again by KE minus G. Now check, if the growth rate changes to 8%, ऐसा कहीं बोला है कि KE change हो जाएगा? Tell me, is it being specified anywhere that KE is going to change? No, no such information is given. So we will always assume KE to remain constant. तो मेरा KE कितना हो गया यहाँ पे? 0.155. Growth rate now turns to 8%. That's as good as 0.08. D1 now. I want D1. D1. So how much is D1 going to be? Should I write 2.1? No. So this is going to be 2 plus 8%. So that's going to be 2.16 divided by 0.075. So that's 2.16 divided by 0.075. And that's giving me rupees 28.8. So this is the formula, and this is the way to compute P0. And the third, the last situation, I have to determine P0 again. Now P0 again, if the growth rate falls to 3%. So now the rate of growth here is going to be considered to be 3%. Formula will not undergo any change. P0 will still be D1 by KE minus G. Now KE, do I know KE? Yes, 0.155. Growth rate is 0.03. Up D1, can I say it will be 2 plus 3%? So that's going to be 2.06 by 0.125. So I say 2.06 divided by 0.125. That's giving me 16.48 rupees. So these are all the different price of the shares. 28.8, 20 and 16.48%. This was a sum on Gordon's formula. So we are done with Walter's approach. We are done with Gordon's formula. Gordon's formula, friends, can come in any chapter. So you don't have to worry. If you are aware about the concept, that's it. That will be more than sufficient. Okay? So you just have to apply the formula. Here, if suppose price of the share, suppose this could have been the scenario like this. Growth rate is 20%. So growth rate becomes 20%. Then the price of the share will become negative. Now when the price comes negative, it means formula fails to work. Why the formula fails to work? Tell me. Because in Gordon's formula there is an assumption that K should always be greater than G. So if it is less than G, the formula fails to work. Okay? So this was your solution to question number 2. This is question number 2. So you can just check it out, the question and the solution. So that was for Gordon's formula. Now, the next sum, friends, question number 3 is actually a sum where both Walter's approach and Gordon's formula is to be used. But somehow, and this is a past examination sum, somehow there is some conceptual mistake in the question itself, but don't challenge the question. if the question comes in the exam like this, that's the reason I've kept it, so that we can understand what's the problem of this question. And if it comes in the exam, please do solve it as it is, the way I'm going to solve it now. So let's read question number 3 now. So let us finish off with question number 3. And once this is done, then we are left with 4 approaches further: Graham and Dodd model, approach, then Lintner's model, and residual approach. So that would be the end of dividend policy as well. Okay, so let's understand what is the question all about. Question says, with the help of the following figures, calculate the market price of the share by using Walter's formula, dividend growth model, that is Gordon's formula. So they are telling us to determine the price of the share. Now first let's use Walter's approach. As per Walter's model, तो पहले तो सबसे पहले क्या लिखने का formula, price of the share is going to be equal to E plus, I would say D plus E minus D into R by KE, the whole by KE. This is the formula. Now let me check for the values. If you notice, EPS is given, so is the case with DPS. So that's going to be 6 plus 10 minus 6. How much is the R given? Internal rate of return on the investment is given, that is nothing but R, friends. Internal rate of return is the rate of return which the project is going to generate for us, that is IRR, that is also nothing but R. Now that is given to be 25%, so that's going to be 0.25. How much is KE? Cost of capital, KE given is 0.2. Now the whole we will capitalize with 0.2. So when I solve it, let's see how much values we are getting. 4 into 0.25 divided by 0.2 plus 6, the whole by 0.2. So here my price of the share turns 55 rupees. Now first of all, can you point out what's the problem of the question? Can you point out the problem? If you notice, EPS is 10, DPS is 6 rupees. It means my payout ratio, 6 by 10 into 100, dividend payout ratio, can I say 60%? It means retention ratio should be how much? 40%. But अगर आप नीचे notice करो, retention ratio 60% दिया है, तो payout तो 4 होना चाहिए, तो वो problem हो रहा है अपने लिए. So actually there is some problem in the question. This is the examination sum, and if a sum comes in the exam as it is, please do solve the way I have solved it. For Walter's approach, ऐसे solve करो. We have to take into consideration all the information. Now the second one now here will be Gordon's formula. Now as per Gordon's formula, P0 is going to be D1 by KE minus G. Now do we know the KE? Yes. KE is 20%, that's as good as 0.2. I need the growth rate. If you will check it out, you will realize there's no information about growth rate given. So I told you hierarchy, first target KE, then target the growth rate, then D1. I have already the KE, now I'll target growth rate. G, can I say, is B into R. What is B now, friends? B is actually retention ratio into return on equity. Now is retention ratio given? Yes. How much it is? It is given to be 60%. So 60% is as good as 0.6. So मुझे वो use करना है. R given is 25%. The return on equity shareholders funds is 25%. That is as good as 0.25. So now when I solve it, it's giving me a value of how much? 0.6 into 0.25. That's going to be 0.15. KE minus G of 0.15. अब अगर किसी तरह D1 मिल जाए तो मेरा काम हो जाए. अब आप क्या करोगे? Should I take, see, we can assume that the dividend per share given is the expected dividend per share. One possible thing you could have taken is you could have taken 6 rupees here, the dividend here. So you could have taken 6 rupees. But if you take 6 rupees, the denominator goes wrong. Because if your retention is 60%, then your payout should be 40%. If you write 6 rupees here, it means you are assuming payout to be 60 and retention to be 40. So that goes wrong. So since you are considering 60% as your retention ratio, you treat 40% here as the payout ratio of the earnings. That means I would say 10 rupees is the EPS into 40%, that is 4 rupees will be the EPS. So this is 4 by 0.05, and in this case it will be 4 divided by 0.05, that's giving me 80 rupees, the price of the share as per Walter's approach. Why did I take 4 rupees here? Because in my denominator, when I'm calculating the growth rate, in computing the growth rate, retention uses 60%, and since retention uses 60%, the numerator payout has to be 40%. And we assume that the earnings figure given, EPS given, is the expected earnings, and hence we have done this calculation in this manner. Have you guys followed this? ये manageable था. Maximum students in the class do get me the answer correctly here. Here what they do is by mistake in the numerator they write 6 as it is. But understand, since in the denominator you have taken 60% as your retention ratio, numerator payout ratio has to be 40%. Clear? Pakka? Fine. So you can just copy it down, and I would suggest please do refer this sum during your exam time, because you know it's a very small and sweet sum. If it comes in the exam, it can fetch you entire marks, friends. So that was question number 3 for us, which is a sum for both Gordon and Walter's formula. Now, so with this I can conclude, friends, 2 models we have discussed which consider dividend as relevant in determining the price of the share. We have one more approach, which is Graham and Dodd model. We don't have any sum on that, because usually if it will be asked in the exam, it can come, if at all it will be asked, it can come as a short note. And let me discuss that stuff. There is one formula also which they have developed. We need to just remember that formula. So we say the next one is Graham and Dodd model. Now as per Graham and Dodd, इन्होंने भी एक formula use किया है, that is P0 is M, where M is nothing but multiplier. We call P0, which is equal to M, which is multiplier, into D plus E by 3. This is their formula for calculating the price of the share. And I would say from exams point of view, ठीक है, it's not that relevant क्योंकि इसके ऊपर ज़्यादा sums वो लोग नहीं पूछ पाएंगे. So as per Graham and Dodd, P0 is equal to M into D plus E by 3, where M is the multiplier. Now Graham and Dodd model is also called as a traditional approach, or we can call it as bird in hand approach. Graham and Dodd model is also called as traditional approach or bird in hand approach. Now what is the viewpoint of Graham and Dodd? They simply raised one question. If suppose you are an equity shareholder, would you give preference to current dividend or future dividends? Given a choice to you, would you want the company to give you dividends, or would you want the company to retain profit? Now don't argue, sir, it depends, R will be equal to or less than or greater than K. No, I'm not telling you that. Let's think about a rational human being and say, would you want to receive dividends immediately? That is, do you want or do you give preference to current dividends, or would you give preference or importance to future dividends? You would definitely say, sir, जो आज मिला ना वो बेस्ट है. फ्यूचर किसने देखा है? बाद में मिलेगा नहीं मिलेगा, उससे बेटर है आज जितना डिविडेंड दे दोगे उतना चलेगा. So as per Graham and Dodd, investors give more weightage, more preference to current dividend over future earnings or future retention. So I would say this way, if given a choice to you, should I retain the profits or should I give it to you? You will say, sir, give it to us. So you are giving more importance to current dividend than to retention. This weightage which you guys are giving to current dividend over retention, this weightage is 4 times as per Graham and Dodd. So an investor is assigning a weight of 4. He is giving 4 times preference to dividend as compared to retained earnings. And there is no logic behind assigning this weight of 4 times. There is absolutely no logic behind assigning this. 4 times is an arbitrary number that has been used. So if you use a weight of 3 times, or if you use a weight of 5 times, then it can become your model as well. So there is no logical reasoning behind assigning weight of 4. As per Graham and Dodd, investors assign more weightage to current dividend than to retention. This weight assigned is 4 times to the dividend as compared to the retained earnings. Why? Because investor अरे जो मिला आज उतना ठीक, बाद में किसने देखा है, कंपनी प्रॉफिट अभी रिटेन कर लेगा तो बाद में देगा नहीं देगा वो फिर पता नहीं, सो जितना हो सकता है उतना डिविडेंड दे दो. So it is like this, a bird in hand is worth considered to be 2 in bush. Whatever you have, be happy with that and get it immediately. So this is nothing but Graham and Dodd model. कुछ है ही नहीं इस मॉडल में to be discussed much. So Graham and Dodd is also called as traditional approach or a bird in hand approach. As per Graham and Dodd, investors give more weightage, more preference to current dividends over retained earnings. This weight assigned is 4 times to the dividend as compared to the retained earnings. There is no logic behind assigning this 4 times. And as per Graham and Dodd, the formula for getting P0 is M into D plus E by 3. That's it. This is your Graham and Dodd model. We don't have any sums in it, but if you want to, for practice purpose, you can actually refer study material. There are 2 sums, easiest sum I would say, which is there in the practice manual. You can very well crack it if you want. Else I would say this chapter predominantly in the exam, from this chapter either they would prefer to ask Walter's approach or they would prefer to ask the MM model. These are the 2 preferred questions on which the questions can come out of this topic. So in dividend policy chapter, give more importance to Walter's approach and MM model rather than giving importance to all these models. Okay? So these were 3 theories which considered, और ये देखो ना, डिविडेंड चेंज होगा तो P0 चेंज हो जाएगा, P0 चेंज हो जाएगा तो वेल्थ चेंज हो जाएगा, एंड प्रूव्ड. So these are 3 theories which considers dividend to be relevant in determining the price of the share and hence the wealth. But there is one theory which is having complete opposite view. Complete opposite view. They say dividend दो या मत दो, wealth of the shareholders stays the same. So dividend policy has no bearing, has no effect on the wealth of the equity shareholders, and that is what is the MM approach. So the next part of the discussion is going to be MM approach or MM model or MM hypothesis of dividend policy. Now friends, let's take up the MM approach for dividend policy or MM model. Now, first of all, tell me what is the viewpoint of MM. MM consider dividend to be irrelevant in determining the price of the share. Rather, I would use the words this way. As per MM, dividend policy of the company is irrelevant in determining the wealth of the shareholders. Whether a company gives dividend or it doesn't give dividend, wealth of the shareholder is unaffected because of the dividend policy of the company. And how they have proved this point. See, as per Walter's model, we have a formula for getting P0. Even Gordon has a formula for getting P0. Graham and Dodd में भी formula है. So MM have also developed a formula for getting P0. So as per MM, how is P0 calculated? As per MM, P0 is D1 plus P1 by 1 plus KE. As per P0 is just equal to D1 plus P1 by 1 plus KE. Now, what does this signify? Can you interpret this? Can you do the interpretation of this thing, this formula? You know what exactly it is? This is D1, dividend at the end of year 1. P1, price at the end of year 1. Can I say this is 1 plus K e raised to 1? We can write it as 1 plus K e raised to 1. So it is actually nothing but discounting dividend of year 1 and discounting the price of the share at the end of year 1 to get P0. So as per price of the share is just discounting. See, it is not D1 plus P1 by KE. ये KE नहीं है. It is 1 plus KE है. And 1 plus KE is as good as 1 plus KE raised to 1. So that is nothing but discounting the dividend and the price of the share of year 1. Now, how did proved their point? How did prove their point? What is the point which they have to prove, friends? The point is dividend policy of the company has no effect on the wealth of the equity shareholders. Arrange money, or rather not arrange money, give whatever profits you want as dividend, wealth of the shareholder gets unaffected due to the dividend policy. How? Let's understand that, friends. To better understand, let's take it this way. Suppose the current market price of the share MPS is say rupees 100. Let me assume this to be 100. The desired rate of return of the equity shareholder is 20%. Now I am telling you calculate P1. So I'm not telling you to calculate P0, but I'm telling you to calculate P1 if company expects to give dividend of rupees 10. So I'm now telling you, get me the price of the share if the company at the end of year 1 plans to give me a dividend of rupees 10. That is, company is planning to declare a dividend of rupees 10. So let us see how much is going to be the price. So if dividend is declared, now if dividend is declared, then I would say formula to P0 is D1 plus P1 by 1 plus KE. So if dividend of rupees 10 is declared, let's see what is going to be the expected price of the share after 1 year. So I would say here the dividend, the P0 is 100 rupees. D1 expected dividend at the end of year 1 is going to be 10. P1 I don't know, but I do know 1 plus KE, that's going to be 0.2. So 1 plus KE is 1 plus 0.02 because KE is 20% in my example. So when I solve it, I can say 100 into 1.2 is going to be 120 equals 10 plus P1. So therefore the price of the share here is going to be rupees 110. Now then they say, let us also now find out the price of the share if the dividend of rupees 10 is not declared. If I give you dividend, then I expect the price of the share to be 110. Now what if I don't give you the dividend? Company doesn't declare the dividend of rupees 10. One situation is company expects to give a dividend and no dividend is given. Now if no dividend is given, then let's see what's going to be the price of the share. So I say if dividend is not declared. So if dividend is not declared, then what is going to be P1? Let's understand. Can current price of the share change? No. So that's already 100. Here D1 is going to be 0. P1 is what I need to find by 1 plus 0.2. So when I solve it, there's going to be 120 equals 0 plus P1, and therefore price of the share at the end of year 1 is expected to be 120. So somebody will now argue, sir, you are saying that whether a dividend is declared and it is not declared, price of the share would remain same. That is what have argued. Now, price of the share will be different, but wealth will remain same. That is what I was arguing. Simply argued here that when dividend is declared, when dividend is given, the price of the share will be 110. That means if you are a shareholder and if company gives you the dividend, the price of the share after 1 year will be 110. But that is not going to be your wealth, because here in this case you will be having one share of rupees 110 plus on top of it, can I say cash of rupees 10 as dividend? Because when I'm going to give you cash, that cash is also a part of your wealth. So when dividend is declared by the company, the shareholder will have one share of rupees 110 and cash of rupees 10 as dividend, making his total wealth at rupees 120. In the second scenario, when the dividend is not declared, the shareholder will have zero cash, but he will have one share worth rupees 120, making his wealth 120. And hence the point is proved, friends. Whether dividend is declared or not declared, the wealth of the shareholder is unaffected because of the dividend policy. Now, in my example, I took dividend of rupees 10. Suppose I make 30 rupees as well. If I make dividend of rupees 30, then what is going to happen? Price of the share still will be 100. This will become 30 plus P1 by 1 plus 0.2. So 1.2, I will hit it here. It will be 120 plus 30 plus P1. 30 will be subtracted. So now my P1 will become 90. Now in this case, I will have share of rupees 90, cash of rupees 30, making my wealth still at 120. So very simple forward, simply they have put their words that whether you give dividend or you don't give dividend, wealth of the shareholders is unaffected. Not only that, they further argued this way. They said, in this case, when dividend is not declared, they say that if suppose a shareholder is interested in receiving dividend, what did argue? They say, suppose if a shareholder is interested in receiving dividend but finds that company didn't give dividend, so what he can do? The shareholder in this case can sell part of his holdings and generate cash, which can be termed as homemade dividends. See, we want dividend we'll get it by way of cash. So further argued that if a shareholder who is interested in receiving dividend finds that company has not given dividend, so the shareholders in that case can sell part of his holdings and generate something called as homemade dividends. In that case also his wealth will remain same. For the second case, they argued that if suppose there is a shareholder who is not interested in receiving dividend but finds that company gives dividend, so what he can do? He can reinvest that cash and buy the shares, turning it into effective capital gains. This way or that way, the wealth of the shareholder will be unaffected. Wealth of the shareholder will be unaffected because of the dividend policy. This is the simplest approach, and I would say more practical as well, because in reality, even if I give you dividend, your wealth should not change, because when you people will learn further, you will realize that when the company gives a dividend, the price of the share will correct by the amount of dividend, leaving your wealth unchanged. So this was all about approach. I will summarize the approach this way. As per wealth of the shareholder gets unaffected because of dividend policy. Whether a company gives dividend or it doesn't give dividend, price of the share will be different, but not the wealth. Wealth of the shareholder will remain same. If the company distributes dividend, then the shareholder here will have a share worth rupees 110 plus cash of rupees 10, making his total wealth at 120. Whereas in the next case, the shareholder is going to have a share of rupees 120, zero cash as dividend, making his wealth still at 120. So whether dividend is given or it is not given, the shareholder's wealth is unaffected due to the dividend policy. Further, argued that if a shareholder is interested in receiving dividends but finds that company didn't give the dividend, what he can do, he can sell part of his holdings and he can generate something called as homemade dividends. Whereas in the next case, if shareholder doesn't want to receive dividend but gets the dividend, he can use that proceeds, buy the shares, turning the dividends effectively into capital gains. So this was all about model and approach. Now let us take up one sum that is based on the approach. Thereafter we are left with only two models, Linton's approach and I would say the next one, residual model. So let us take up question number 4 and I would exhaustively discuss that approach of question number 4. There are extra things to be discussed, but that I'll discuss it as and when I'll solve these sums. So before we proceed further, I'm again telling you, exam point of view for dividend policy, do not fail to refer Walter's approach and model, because these are examiner's favorite thing that can come out of dividend policy. So you can just have a look at the example that I have. Okay, so now let's take up the next sum, question number 4. Question number 4, let's read it. RST Limited has capital of rupees 10 lakh, which are in equity shares of rupees 100. The shares are currently quoted at par. My dear friends, tell me, what do you understand by the word shares are currently quoted at par? The shares are of rupees 100, they are quoted at par. It means the present market price of the share is rupees 100. The company proposes to declare a dividend of rupees 10 per share at the end of the current financial year. The capitalization rate for the risk class of which the company belongs is 12%. What is this capitalization rate? Tell me. The capitalization rate is actually nothing but KE. Okay, so let's take up a question number 4 that is on approach, and I'll be doing some discussion in this question itself. So the approach is not just restricted to what we have done. There are some further discussions that are going to occur. So let's read that question number 4. RST Limited has a capital of rupees 10 lakh, which is in equity shares of 100 each. The shares are currently quoted at par. How would you interpret this, that the shares are currently quoted at par? It means the current market price of the share is rupees 100. The company proposes to declare a dividend of rupees 10 per share at the end of the current financial year. The capitalization rate for the risk class of which the company belongs is 12%. Now what is this capitalization rate? It's actually nothing but KE. What will be the market price of the share at the end of the year if dividend is not declared? If dividend is declared, then the question says, the third point, assume that company pays dividend, has net profit of 5 lakh, makes new investment of 10 lakh during the period. How many new shares must be issued as per the model? What I would like to do is, I would suggest that in the third point you add something further. They have just said that you assume company pays the dividend. I would say assume company does not pay dividend. Just add this, assume company does not pays the dividend and pays the dividend. So I'm taking up both the situation. Assume company does not pay dividend and pays dividend and has net profits of rupees 5 lakh and has made investment of 10 lakh during the period. How many new shares must be issued? And while doing this calculation, we have to follow approach. So first of all, what I would like to do is I will simply write the formula of So as per P0 is D1 plus P1 by 1 plus KE. Now, there are two situations. First situation is dividend not declared. And in the second situation, they say dividend declared. So under both these scenarios, what is the required part? They say what will be the market price of the share at the end of the year? What will be the price of the share at the end of the year if I don't give dividend and if I give dividend? So if I do not give dividend, so then D1 can I say will be 0. P1 is what I need to find. What is the capitalization rate? 12%, that's as good as 0.12, and the price of the share is assumed to be rupees 100 here, and here it's going to be 100 rupees. Dividend of rupees 10 here plus P1 is what I don't know, so that is to be found. That's going to be 0.12. So when I solve this, this becomes 112 is equal to 0 plus P1. Therefore, price of the share here is 112. If you notice here, this is going to be 112 equals 10 plus P1, and therefore I would say P1 is 102. Tell me, chartered, if you are following approach between the two situations that we have, not giving dividend and giving dividend, as per which approach or which option would you like? You should be indifferent, because in both the cases your wealth stays the same. How come, sir? Here you are having one share of 112, 0 cash, making your wealth at 112. In the next case, you have a share of 102 and you have a cash of rupees 10, making a total wealth of again 112. So a shareholder, as a shareholder, you are indifferent whether you get dividend or you do not get dividend. You are indifferent because your wealth stays the same. So that becomes the answer to the first point and the second put together. Now the third one stays what? In the third one, there are two scenarios, I would say. We have to determine what? Assume company pays the dividend and does not pay the dividend. So we say this way, company does not pay dividend, because that is what I have added to the question. Does not pay dividend. Does not pay dividend. And in this case, it pays dividend. So this is actually answering the third point put together. Does not pay dividend and pays dividend, has net profit of rupees 5 lakh, makes new investment of 10 lakh during the period. How many new shares must be issued? So let's take it this way. Assume that the company gives the dividend. So when are we going to give this dividend? Not today, but in future. And we have net profit of 5 lakh. That means they are telling me that this net profit is not of current year, it is of upcoming year. So I would say, assuming that the earnings given of the net profits in the form of net profit is actually the earnings for the equity shareholders. So whether I pay dividend or I don't pay dividend, I have earnings of rupees 5 lakh. Now, if I'm not going to pay dividend, that means entire amount I'm going to do what? I'm going to retain. Here, I'm going to give dividend of rupees 10 per share. How many shares we have? If you notice, friends, capital is of rupees 10 lakh, in equity shares of 100 each. So we have 10,000 shares, and if I'm going to give 10 rupees per share as dividend, my dividend amount here will be rupees 1 lakh. It means if I don't give dividend, then I will retain how much? 5 lakh rupees. And if I'm going to give dividend, then my retention will be 4 lakh. Now, why would a company like to retain the profits? What's the objective to retain the profit? The profits are going to be retained so that it can be reinvested. So if there are any new projects in the chapter of, I think if I'm not mistaken, cost of capital, I would have mentioned somewhere that we retain profit so that it can be reinvested, it can be put to use in the business again. Now, what is my planned capital expenditure? In the upcoming year, there is a planned capital expenditure of rupees how much? If you can check, please. The company plans to make new investment of 10 lakh during the period. So my planned capital expenditure is 10 lakh. तो कोई भी सिचुएशन हो, मुझे 10 लाख का इन्वेस्टमेंट करना है. अच्छा, अगर आपको 10 लाख रुपए का इन्वेस्टमेंट करना है तो आपके पास ऑलरेडी यहां पर 5 लाख पड़ा है. तो डोंट यू थिंक यू वुड लाइक टू यूज दैट 5 लाख रुपीज हियर? So first priority, I would love to give it to the retained earnings because of less of time consuming, no flotation costs, everything. So I would say less retained earnings available for investments. So I can use 5 lakh rupees here and I can use 4 lakh rupees here. Now if I can use 5 lakh rupees here, then I have to now raise 5 lakh rupees to meet my planned capital expenditure. If I'm going to keep 4 lakh rupees here, I require 10 lakh. That means, can I say 6 lakh rupees का fresh issue करना पड़ेगा? So that whatever planned capital expenditure I'm going to make, I'll be able to meet that plans. So I would say this is going to be like fresh issue. Now in model, what assumption they are going to make in respect of this case? They say, see, if I want 5 lakh, if I want 6 lakh, do you agree? This amount I can arrange from n number of sources. Numerous options I have. I can raise this amount by way of issuing preference shares, bonds, debentures. So many options I have to arrange this money. But the assumption made is the only source of finance that is available with us is going to be equity. So this much amount of fresh issue will be made. Not now, huh? It is not now. It is presumed that all these calculations of capital expenditure, profits and all are after 1 year counting from today. So if this is what is going to be the fresh issue, this is going to be fresh issue of equity. So the question that they have asked is, how many new shares are we supposed to issue? So what will I do? I'll divide this with the issue price of the share. Issue price per share. Now tell me chartered, we have done this discussion in capital structure, we have done it in cost of capital. If the company is already an existing company, plans to go for fresh issue by way of equity, we will be free to assume that the new share will be issued at what? It will be issued at the prevailing market price. Now that prevailing market price is not today. Capital expenditure ही 1 साल के बाद होने वाला है. तो the then prevailing price after 1 year, जो then the prevailing price after 1 year होगा, तो I will issue that price share at 112 because that is what is the price of the share expected when I don't give dividend. Whereas here, if you notice, it's going to be at 102 rupees. So this will give me the number of new shares to be issued. Number of new shares to be issued. Number of new shares to be issued. So here in this case, I would say 5 lakh divided by 112. That's going to be, I will issue 4464 shares. And the next case, 6 lakh divided by 102. In this case, I'll be issuing 5883 shares. So this we can round it off. If one will make it 4465 shares, and this is 5883 shares. So here these many shares will be issued at 112, which can help you to get 5 lakh rupees. Here you will have to issue more number of shares at 102 for 6 lakh rupees. So what we are going to do, we are going to issue less number of shares here. And since we're going to issue less number of shares, why are we supposed to issue less number of shares? Because my retention is more. My requirement is less, so I'll issue less number of shares. Here I will issue more number of shares because I am going to give dividend and I'm not going to keep it with me. So the profits available for investment itself is less, so we'll have to issue more number of shares. So I have gone one step further, and they had asked us that only this much. Assume that company pays the dividend. I said no, let's assume doesn't pay dividend and pays dividend. Then what are the number of shares that we are going to issue? So here, if you don't give dividend, then 4465 shares will be issued, and in the next case it will be 5883 shares. Now there is one last point that is remaining. That's not the required part of this sum, but we can actually make it. What argued? First of all, from investors' point of view, what did they argue? Whether the company gives dividend or it doesn't give dividend, wealth of the shareholder remains the same. So given a choice to the investor, what would investor expect? Receiving dividend or not? He is indifferent. He is simply going to be indifferent. Now, further argument placed by was the way investor is indifferent, it doesn't matter to the company also whether it gives dividend or it doesn't give dividend. It doesn't matter to the company also whether it gives dividend or it doesn't give dividend, because even the worth of the company, the value of the company remains the same whether dividend is given or not. समझा मैं क्या बोल रहा हूँ? कैसे वो मैं समझा रहा हूँ? The way investor is indifferent to the dividend policy, argued that even company is indifferent whether it gives dividend or it doesn't give dividend, even the value of the company would remain same. How? Let's understand that. So that itself is going to be the last point of the discussion. That is, I can say, extra discussion we can say, where I have to show by way of working that whether dividend is not given or given, the value V, worth of the company, will remain the same. Kaise? Let's understand. So we say does not pay dividend. Who doesn't pay the dividend? The company. And pays dividend. So let me calculate the value. See, first of all, I have clearly instructed that we have only one source of finance, that is equity capital. It means we don't have any debt, we don't have any preference capital, and when we don't have any debt or any preference capital, we can simply conclude V, value of the company, can I say, will be just equal to E, cost of capital. V equals E plus D. So here V will be just equal to E. Now let's understand how we will get that. First of all, what are the number of existing shares? Number of existing shares. I think we already have 10,000 shares. Number of new shares. Now at the end of year 1, in this case, when we are not going to pay any dividend, we'll be issuing 4465 shares, and here it's going to be 5883 shares. That means I can say the total number of shares, the total number of equity shares, whether dividend is not given or given, now here is 14,465. This is 15,883. My objective is to get the worth of the company, V, value of the company. So what I can now do is I can multiply it with the market price of the equity share. That will give me value of equity, the worth of equity, that is going to be denoted by letter E, and that itself is going to become V because we don't have any debt in it. Now I'll multiply this with the market price of the share. And what is the market price of the share if dividend is not declared? The dividend, if it is not declared, the market price of the share is 112, and here it is 102. So let's calculate the value of the equity, and you will be appreciating the fact that the value remains the same. So this is 16,20,080 and 15,883 into 102. That's going to be 16,20,066 rupees. So this is the value of the company. There's a difference of 14 rupees that is coming in the difference in the value, and that's only because of the rounding off of the shares that I've done here. So because of the rounding off done, my value of the company slightly differs. But if I now tell you, for company, whether it gives dividend or it doesn't give dividend, will it make any difference, friends? No, because whether it gives dividend or not, even its worth remains the same. So the way investors are indifferent to dividend policy, even company is indifferent to the dividend policy, provided the assumptions are true. Now, what are the assumptions? Company can raise the money only by way of equity. There are no flotation cost, and there's no dividend distribution tax, there are no taxes and all that stuff. So if these assumptions are true, then only all these calculations that we have discussed will make sense, else they will not. So this was your approach. My personal suggestion is, please do refer approach in the exam. Maximum 3 things can come in approach, maximum. Three types of question I would say. One, they will tell you find the price of the share. One option is they will tell you price of the share in both the cases, whether dividend is not declared and dividend is declared. That is one type of question that can come. The second type of question that they can come is calculate the number of new shares to be issued if dividend is not declared and is declared. That is the second situation. The third, they will tell you show value of the firm remains the same whether dividend is declared or not. So maximum this is what can come in approach. So I would suggest strongly that please do refer this approach in your exam, including the Walters model as well. These are the two things from dividend policy chapter point of view which are relevant. Is it okay? So with this we are done with the dividend relevance theory, we are done with dividend irrelevance theory. The only aspect of this chapter which is remaining is now practical approaches. Now let's understand those practical approaches in a while. So after discussing the dividend relevance theories and irrelevance theories, let us take up the next segment, that is going to be the practical approaches of dividend policy. So we have now practical approaches. In practical approaches, we have to first learn Lintner's model, and the next one is residual approach. I will first discuss Lintner's model. I would say these are theory type of stuff in dividend policy, so expecting a sum in the exam out of this seems to be remote, but nonetheless they can come. So let's understand the Lintner's model. The model starts this way. Lintner's model is based on series of interviews which he conducted with corporate managers. Means this person actually went company to company with his questionnaire, and he conducted interviews with corporate managers, and after all the interviews he conducted, he then summarized his findings, and we need to understand those findings. That's it. That's all about Lintner's approach. So Lintner's model is based on a series of interviews which he conducted with corporate managers. And what were his findings? So his findings were as follows. Now in order that you guys should remember these findings, let's take it this way. I am the person who is going to take your interview and you guys are the corporate managers. So I'll be asking few questions. Think as if you are a corporate manager or a finance manager. What answer would you give? Now one question that was asked was, is your company having or following any kind of target payout ratio? Does your company set any target payouts? Have they any target payouts? So you would realize that every company has its own target payout ratios. In a particular year, they might deviate from my target. In a particular year, they might deviate from their target, but in long run, they would always like to maintain their targets. So first finding was that this is just finding, you need to be getting well versed with. That's it. Yes, if findings are actual findings. Every company has a target payout ratio. In a particular year, it might happen that the company would deviate from its target, but in long run it would like to maintain its target payout ratio. That's the first finding. The second finding was the managers are not bothered with the dividend per share. The managers are not bothered with dividend per share, rather they are bothered with changing the dividend per share. Now, so what does it mean? What this says? It means that if you are a corporate manager and if I ask you how much dividend are you planning to give in current year, you would say to an extent it is dependent on what I paid in the last year. So suppose last year you paid a dividend of rupees 5 to your equity shareholders. Now if last year you have paid 5 rupees, in current year you would not be reluctant, you won't hesitate to pay 5 rupees, but you will really hesitate, you will be really reluctant in paying dividend of rupees 10 if last year dividend paid was rupees 5. Why so? Because you will always have an inherent fear. The moment I pay 10 rupees in current year, which is almost double than what I paid in last year, automatically, the benchmark is set. Now the equity shareholders will expect more dividends every year. It might happen that I may not be able to meet their expectation. So as a manager, I am not bothered with dividend per share, but I am really bothered with changing the dividend per share. A manager will not be reluctant to pay dividend of rupees 5 in current year if last year also dividend paid was 5. But he will really hesitate to pay dividend of rupees 10 in current year if last year dividend paid was 5, because of the inherent fear. There's always going to be a fear that he might not be able to maintain the same level of dividends every year. The third finding was, that was the second one. The third finding was managers always love to smooth the dividends. Sir, what is this? Tell me honestly, do you think every company will earn same level of profits every year? Can I say earnings are always fluctuating? So earnings keep on fluctuating. Now if the earnings keep on fluctuating, do you think the company should pay dividend as per the earnings, the way the company earns the dividend, the profit? No, not at all. Managers would like to smooth the dividends. They want that the dividends of the company should follow a smooth path. It means even though the earnings will be erratic, even though earnings will keep on fluctuating, but they want that the dividend should go for a smooth path. That's a finding. That's it. Even though earnings fluctuate hota rehta hai, managers, they will not fluctuate their dividends. They will want that the dividend should follow a smooth line. They want the dividends to follow a smooth path. That was his third finding. And his last finding was a formula. So as per Lintner, he developed a formula which is for current year DPS. Current year DPS. You need to remember this formula, friends. Current year DPS is equal to, so understand, first 4 approaches dealt with determining the price of the share. This formula is not for price of the share. It is to determine the dividend per share. Now how it is calculated? Current year DPS is dependent on what was paid last year. So we say it is last year DPS plus not only the dividend per share of current year is dependent on what we paid last year, but to an extent it is also paid on the basis of current year EPS. So how much we earned in current year, that also is one factor that determines the price, I would say current year DPS. So dividend of current year is dependent on what I paid last year plus current year EPS. I will multiply it with my target payout ratio. Now when I multiply with target payout ratio, this is going to give me what? Target DPS of current year minus the last year DPS into something known as adjustment factor. That is speed of adjustment factor. The way in Graham and Dodd model, 4 times weights assigned was arbitrary number. Adjustment factor here, the speed of adjustment here is also an arbitrary number. So actually, according to me, I would say this is mathematically a balancing figure. So if last year dividend was 5 rupees, and if I decide that I'll give you 7 rupees in here, so if I want to put it in the equation, that adjustment factor mathematically would become a balancing figure. So this was Linton's model. His model is based on a series of interviews which he conducted with the corporate managers, which had his own findings. First finding was we have target payout ratio. Second finding is managements are reluctant to change the dividend per share. Third, even though the earnings are erratic, the managers want the dividends to follow a smooth path, and this is the formula which he has developed for calculating the current year's DPS. And I would say the last thing, that is that adjustment factor is going to be like an arbitrary number. So this was Linton's model. The only model for this chapter that is left now, we don't have any sums on this. This is like a theory. The only thing that is now left in this chapter is the last approach, which is residual approach. So let's finish off the residual approach. And that too is very easy for us to understand, the residual approach. Now, first of all, as the name indicates, residual approach of dividend policy. Residual, बचा कुचा profits जो भी रहेगा वो दे देने का as dividend. Now to better understand, you will not find any sum anywhere, but I'll tell you how we could have actually learned this concept of residual approach. Suppose, friends, let's presume this way. The company has earned profits for equity shareholders of say rupees, let's presume 5 lakh. This is the profits which the company has earned. Suppose there is a planned capital expenditure. We expect that we are going to make up a capital expenditure, a project hai koi, and we expect that we are going to incur a capital expenditure of rupees 4 lakh. I now tell you, calculate the amount of dividend which the company would distribute. There are two situations, but I'm keeping silent about that two situation. But now if this is the scenario, you guys tell me how much dividend should I distribute. Now if you notice, already I have earned profits for my equity shareholders of rupees 5 lakh. Now if already I have earned 5 lakh rupees, then I am planning that I will need money because there is some project available and I'm planning to capitalize that amount in that project. So if I know that there is amount which is going to be required, so what will I do? To the extent of my requirement, I'll keep it with myself. To the extent of my requirement, I'll keep it with myself. Balance, surplus, if any, I'll give it as dividend. So what will I now do? If I've already earned 5 lakh rupees, I know that there's going to be a planned expenditure of rupees 4 lakh. Simple thing that I would do is, I'll keep 4 lakh with me. Extra amount which I have, I'll give it to you as dividend. So I would say less retained to meet capex. So to meet capex, I will retain 4 lakh rupees, and residual amount that I now have of 1 lakh, this is what I'll give you as dividend. Residual approach. This is all about residual approach. But now friends, suppose if I add a situation here and I say, rather let me make it B because this is going to be like A situation. Calculate the amount of dividend which the company would distribute if it wishes to maintain a capital structure of debt equity of, I would say, 1:3. If it plans to maintain the capital structure, then how much dividend can the company give? What does it mean? What does it mean? Here, the company would want to maintain its capital structure in the ratio debt equity of 1:3, because company considers this capital structure to be the best. Probably this would have helped the company to reduce its overall cost of capital. So this is the optimum capital structure. Now if this is the condition that I now input here, that I want to maintain my capital structure, then in that case how much dividend can I distribute? So first of all, what is my planned capital expenditure? Now, planned capital expenditure is 4 lakh. Now if I am interested in maintaining my capital structure, what will I do? How would I finance this project? If I'm interested in maintaining my capital structure, then how would I plan to finance this project? It will be financed in the ratio of debt to equity. In which ratio? It will be in the ratio 1:3. That means irrespective whatever are my profits, I would love to finance this project by raising debt of 1 lakh, and 3 lakh rupees I will use equity to finance this project, because I find this capital structure to be the best, as at this capital structure my KO will be minimum. Now if I tell you, if you are interested in maintaining your capital structure, then how much dividend should you distribute? So I'll again start this way. Earnings for equity shareholders. How much we have earned? 5 lakh. Then now I'll say less retained to meet not capital expenditure but capital structure. Because if I reserve 3 lakh rupees, that's eventually going to form part of what? Equity only. So उतना मैं मेरे पास रखूंगा. 2 लाख रुपीस सरप्लस जो है वो सरप्लस मैं डिविडेंड दे दूंगा. So did you get this? This becomes the B part, where I am interested in maintaining a capital structure. If I'm not interested in maintaining my capital structure, then I would give 1 lakh as dividend. So I would say calculate the amount of dividend which the company would distribute if it is not bothered with capital structure. So if it is not bothered with capital structure, then you will give 1 lakh as dividend. If you want to maintain the capital structure, then you will give dividend of rupees 2 lakh. So this is what is your residual approach. These are the two situations that can come in the exam, which would ask us, ki bhai, if this is the scenario, how much dividend can we give if we are not interested in maintaining the capital structure? If we are interested in maintaining the capital structure, then how much dividend should we give? So these were all your dividend policy theories which we had to cover up in the chapter of dividend decision. Basic motive is very simple. Motive is whether we should decide whether we should give dividend or not. That decision was to be given. Now that depends upon what is going to happen to the wealth of the shareholders. So there were few theories which stated that yes, the dividend policy, the payout ratio of the company does affect the market price of the share and consequently the wealth. So those were Walter, Gordon and Graham and Dodd model. There was one theory which considers dividend to be irrelevant in determining the wealth of the shareholder, and that was approach. And under the practical head, we had residual approach and we had the Lintner's model. This was what we were supposed to cover up in dividend policy. My suggestion and personal opinion, unsolicited advice to you guys would be, in exam, when you do your revision, ensure that you at least, if you're not able to cover up entire stuff, please do refer Walter and the model, because that is the only thing that is most important out of the remaining theories. Fine. So we are done with the chapter of dividend policy. Thank you so much.